January 19th of this year is the closest we've got on a 52-week range for David Burrows of Barometer. And when he was on the program, he brought with him two top picks, and the third one was not a pick at all, broadly speaking. But since then, you've told us that you are the most bullish you've been in 30 years. So we'll get to cash in a moment.
Yeah.
But let's talk about top pick number one, which is McDonald's.
Yeah.
You're up by 7.7%. You still loving it?
I would own the stock today, but I would tell you that I would prefer to be in more economically sensitive sectors.
That sounds like you sold your position.
Yes. If you look at where we were in January of last year, we tracked breadth in the market. Breadth turned down in the U.S. market at the beginning of December, and in the third week of February turned higher from the lowest point in 5 years, giving us the best entry point in 5 years, happened 5 times in 20 years. So at that point, it was time to put the pedal down a little bit, get less cautious, and a little bit more cyclical, a little bit more economically sensitive. So the positions put on from that time to now have been much more economically sensitive.
Street consensus is it's $128 a year from now, so that's only about a 5% total return, and that includes a 3% dividend.
Yeah, restaurant group is actually lifting with the consumer discretionary group. McDonald's is behaving well. I just think maybe there's other better risk reward.
Microsoft is the big gainer within your recommendations. It's a 28% return since the 19th of January. How do you feel about the house that Bill Gates built now?
I think this is just beginning. So we'll talk about this more as we go through today. But I think that when you look at the NASDAQ 100, you could look at it today, making a new all-time high. We only just took out the highs from 2000. Many of the companies in the NASDAQ 100 are generating a boatload of cash and very strong dividend growth, and will, I think, be the destination for the dividend hunters' money. They grew their dividend 20% a year over the last 5 years. You got a very good dividend. I'd far rather be there than, say, in a utility or a telco or a REIT.
Okay, so let's get into the cash conversation, because as I said, you're now most bullish you've been probably in your entire career, I would think.
Right.
You said 30 years. Which means you've most likely been in this business since you were 5. Cash. What percentage of your portfolio was in cash this time last year, and do you have anything on the sidelines now? So
we are fully invested. There's a time to play defense. Our clients hire us to generate a risk-adjusted return. There was basically a market pullback going on around the world at this time last year. And so we had roughly 50% of our portfolio exposed to equities, the balance either in cash or hedged. In the third week of February last year, breadth, or the percentage of stocks performing well, was only 20%, and it started to expand, meaning that's money going to work. At that moment, financial advisors were more bearish than any moment going back to a week after the crash in 1987. And there was more cash on the sidelines than any time going back to 2001. So we believe we're in the early stages of a secular, multi-year revaluation of equities relative to other asset classes. So it was time to start putting money to work in February, and it has continued on from there. The bull market in the S&P 500 is 8 years in, and some argue it's long in the tooth, and we're due for a pullback. We're due for a recession, quite frankly. So let's talk about this. 8 out of 10 bear markets come to a recession. There is no indication at this point of anything mildly recessionary. If you look at the long history of stocks, when the market takes out the high from the previous secular bull market, which ended in 2000, that is when you've begun a new bull market. That's when multiples tend to start to expand. Yes, we came off the lows in 2009. It took to 2013 to take out the highs. We rallied for 2 years and then pulled back 15%. That's virtually identical to taking out the highs in 81, rallying 82, 83, pulling back in 84, 15%. The market went up 130% in the next 2 years through 85 and 86. In 1951, you took out the highs from 1929, rallied 2 years, pulled back 15%, and then went up 105% in the next 2 years. And that was really what kickstarted the next 15-year bull market. So people became exceedingly cautious and skeptical by February of this year, and it will take years for them to rebuild sort of a bullish stance in their portfolios. You want to be involved.
David Burrows is the president and chief investment strategist at Barometer Capital. We're taking your questions on North American large caps. If you've got one, we've got a line open for you at 1-855-326-6266.